14 of 21 series are aligned with STAGFLATION mild this morning. That is a moderate, but not extreme level of agreement across the full regime map. The current macro regime is STAGFLATION mild, with a confirmation score of 14 out of 21. In this configuration, the macro regime reflects growth momentum decelerating at approximately -0.5655 on our normalized scale, while inflation momentum is accelerating at about +0.0081. Coherence score sits in a moderate range, and the confirmation score of 14 out of 21 indicates that roughly 2/3 of our 21 series are mathematically aligned with this stagflation-light profile. By our framework's reading of comparable historical conditions, regimes with this type of confirmation score persisted around 41% of the time, over rolling 3-month windows, with acceleration emerging as the most frequently observed next state. Compared to last week, regime alignment has been relatively stable in count, even as individual series such as inflation expectations have firmed and labor metrics have softened around the edges. Historically, environments that look like this in the math have felt like pressure cooker markets. Inflation expectations edging higher, growth data losing incremental momentum, and cross-asset behavior turning more idiosyncratic beneath headline indices. An observational description of past configurations, not forward guidance. Turning to yields, long rates, and the 10Y2Y curve are in red momentum. In our framework, that means the rate of change in yields is negative versus the intermediate look-back, while the curve remains compressed relative to its historical mean. In our framework's reading of comparable periods, this roughly coincided with uneven equity performance and more frequent rotations between duration-sensitive assets and cyclicals within 3 to 6 months. An observation under our methodology, not a forecast. On the labor side, payrolls and claims together are also scoring red. The math is capturing slower improvement in payroll growth and less favorable dynamics in initial claims, which translates into weakening rate of change relative to prior months. In our framework's reading of comparable periods, this roughly coincided with broader confirmation scores deteriorating and a drift toward more defensive sector behavior within a quarter. Again, an observation under our methodology, not a forecast. Credit conditions, incorporating spreads and dollar strength, are leaning mildly restrictive. The framework reads this as yellow momentum, neither strongly improving nor materially deteriorating, with spreads off their tights but not blowing out, and the dollar firming versus pre-shock levels. In our framework's reading of comparable periods, this roughly coincided with more sensitive reactions to macro surprises and higher dispersion within corporate credit and high beta equities over 3 months. An observation under our methodology, not a forecast. Within equities, sector rotation is reflecting the same tension. Technology has held up better than cyclicals, while rate-sensitive areas like real estate and gold proxies have come under pressure. Our math tags this as a mixed profile, with green momentum in select growth segments and red in more defensive or duration-linked pockets. In our framework's reading of comparable periods, this roughly coincided with choppy index paths and stronger factor-level divergence within a few months. An observation under our methodology, not a forecast. On the conditional map, 2 triggers stand out. If the 10Y yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, a clearer inflation acceleration pattern appeared in roughly 9 of 11 comparable conditions. A historical characterization, not a forecast. In regime terms, that type of move has historically strengthened the mathematical case for transitions from expansionary mixes into more pronounced acceleration regimes in our sample. If the fear and greed index drops below 15 and holds for 5 consecutive sessions, in our framework's reading, a deterioration in confirmation scores appeared in roughly 7 of 9 comparable conditions. A historical characterization, not a forecast. That configuration has historically coincided with our engine tagging lower confidence regimes and raising internal regime watch flags under the methodology. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated, rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed four-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 symbols every trading day. When all four layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the four layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the four layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. These readings are framed as potential and educational characteristics of past data, not outcome promises. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.